When I think about the broader credit data landscape, let's say there's maybe three categories in my head. There is traditional data, and I'll define traditional credit data as the data that's commonly used here in the United States in a FICO score or a Vantage score. Right, so national credit reporting agencies like Experian, TransUnion, Equifax, they offer alternative and traditional, but I would really point to the kind of trade line data that drives those FICO and Vantage scores as being traditional data. To me, that data is incredibly predictive. It should be a part of every lender's credit evaluation process. I think increasingly people just realize it may not be enough to gain competitive advantages making truly efficient lending decisions. Second category would be alternative credit data. And so to me, that is data that here in the US meets both all of the regulatory requirements of data from an FCRA perspective that would be used in taking adverse action on a lending decision. So the data is disputable, for example, that's going to be a really big one. This data also, though, needs to adhere to, let's say, the less formally enshrined rules that regulators increasingly care about. We know consumers care about. You can think about things like consumer transparency, for example. Will consumers understand why this data is being used to evaluate them? That's going to be a really important part of this. And the last category to me, and maybe we're providing the guardrails for alternative data, if traditional was on one side, experimental would be on the other, right? And that's data which very well may be predictive of credit risk, but struggles with some of those regulatory issues, or has maybe a correlation but no causation, no true formal relationship with credit risk long term. So those are my three core buckets. And I would argue that the answers to those two questions may initially conflict a little bit. And what I mean by that is I think the consumer segment that this data has the most impact on may not be the consumer segment where lenders stand to realize the biggest ROIs from the use of alternative data. So I'll answer in that sequence, what consumer segments are going to be impacted by alternative credit data the most? I think inherently that's going to be consumers who are on the outside looking in terms of access to traditional financial products. So that's going to be credit invisible consumers who do not have a FICO or Vantage score. Right now, there's very little information in a traditional credit flow that would lend a lender to, or cause a lender to approve them. Alternative data can thus completely flip a decision and turn a no into a yes for that group. And subprime consumers are also to a certain degree in this bucket as well, because they're already sitting in the decline category. And is there additional information that might have big changes in their ability to access credit found in alternative data? So that's the biggest needle mover on a consumer segment population. I would argue, though, from a revenue impact, the biggest area for value in lenders is using this on near prime and prime consumers who are credit visible, who have a FICO score. That is where, let's be honest, the majority of applicants for most common financial tools are going to sit, and where the most competitive advantages tend to lie.